Okay, we're going to get started. Welcome everyone to this offering webinar. I'm so glad for all of the folks that have joined and excited to send this video out to anybody who couldn't make it. This is an offering webinar video talking about the Tyler-Longview portfolio. It's a self-storage portfolio in East Texas and why we're so excited about it. So let's jump right into it. I'm Suja Sham with Luxe Capital, and a little bit about us. We are a private equity fund, and our role typically in this situation is we spend a lot of time and money and resources finding amazing operators. We analyze their deals, we put them through rigorous due diligence process, and we're looking for the best commercial real estate investing deals. We pool investor capital so that we can invest as one large investor, and that allows us to get preferential treatment, and that's one of the ways that we get compensated. The main way is the delta between the shares that our investors provide and the shares that the large pool of money that we're putting in together gets a higher share. So that's how we get compensated. And just as a side note, Luxe Capital always invests alongside investors. We like to put our money where our mouth is, and we think these are great, amazing deals, and we want to invest in them as well. So that's who we are. And one disclaimer, please make sure to consult your tax and legal professional before getting involved in a real estate syndication. This is not advice. Make sure to seek outside counsel. This is a general overview. Keep in mind that information contained within could be subject to change, and perform your own due diligence. So why do we like self-storage? Here's a quote, I'll just read through it briefly. The sector has been recession resistant because the demand for self-storage space is based on life events such as marriage, divorce, renovating, and relocating. During the Great Recession, self-storage was one of the least foreclosed on real estate sectors. So in short, self-storage tends to do really well in times of economic contraction and in times of economic expansion in volatile times. It is a very easy to monetize, easy to manage, easy to maintain asset class, which also makes it very recession resistant. Here's a graph that shows how well self-storage REITs have performed compared to the S&P 500. So if you can follow that green line, it's self-storage REITs have obviously done extremely well compared to both the S&P 500 and all REITs in general. A REIT is a real estate investment trust. So that's another reason we love self-storage, because it's just purely doing so well. Sounds like a niche asset class, but it's becoming more and more well known, and it's definitely something to pay attention to for any savvy investor. So why do we like self-storage? As I mentioned before, easy to maintain, easy to manage, and easy to monetize. So what does that mean? As compared to other real estate, like multifamily real estate, self-storage is very simple. There's very few systems. There's very little plumbing, very little electricity, no appliances, countertops, low maintenance. It's easy to manage because it's people's things. It's not where they live. So if they're going there, it's usually just for a short period of time. They don't care as much about it. And so it's just in general much easier to manage and to please tenants and to provide a great service. Also, it's easy to monetize, which means that self-storage is not actually subject to the same laws that multifamily rentals are subject to, for good reason. So if a tenant stops paying, it's much easier to get them to either start paying again or to remove them so that another tenant can move in that is able to pay. So it's very favorable from a risk-adjusted perspective compared to several other commercial real estate classes. So here's a look at self-storage as it compares to multifamily and single-family homes. We all know that real estate is tax advantaged, and all three of these asset classes are tax advantaged. All three of the asset classes have a pretty good average stay. And one way that multifamily beats out single family homes is that it benefits from the economies of scale. So essentially you can make more money purely because you have one property, many properties under one door, rather than single family homes. You have too many addresses, it's a lot to manage, and it's hard, you don't benefit from the economies of scale. So self-storage, you also benefit from the economies of scale. Obviously, there's hundreds of units potentially on a single site. And in self-storage, we also have several other benefits. It's easy to automate, it's low maintenance, which I already talked about, and it's easy to reduce bad debt and issues of rent collection. So you might be wondering who actually uses self-storage. It's certainly something that I wondered as I was getting into this asset class. Actually, 1 in 11 households rents a self-storage unit. And in addition to households, local businesses, general contractors, logistics companies, companies who are needing to take care of relocation, there's actually a huge number of businesses and individuals that actually use self-storage. And 1 out of 11 households, it's actually quite a significant number. This slide is just basically about some of the tax benefits associated with self-storage and other types of multifamily commercial real estate. And basically, I'm not going to go too much into depth on this particular slide, but it basically shows how we can depreciate a huge proportion of the asset in the first year, which is very beneficial for folks who own other passive investments, who own real estate. And it's a tremendous value, which you'll learn more about as you get into commercial real estate investing. And let's look at an industry snapshot of the self-storage industry. So the self-storage used to be kind of the red-headed stepchild of commercial real estate. It's growing. It's one of the fastest growing sectors in commercial real estate. And it's actually a substantially well-known asset class now with $38 billion in annual industry revenue. And like I said, 1 in 11 households using self-storage. So it's becoming a known quantity, and it's becoming less of a niche asset class and something that's more well understood and well known. So what are some of the challenges associated with self-storage? Well, because the cat's kind of out of the bag, there was a huge amount of construction of self-storage in the last 5 years or so. That supply kind of peaked in terms of coming onto the market in about 2018. And it's coming down now, and that oversupply has led to a little bit of rent contraction in certain markets. So how do we deal with that particular challenge? Well, first of all, we look at where the supply is being built. And in most cases, the supply is being constructed, the new units are being constructed in major metros, so primary markets. How we deal with that is we simply stay away from those markets. We make sure we locate in markets that are secondary markets where the larger self-storage companies aren't going to bother. And we make sure that there is plenty of demand for the amount of supply that is in those existing markets. So that's how we handle that particular market challenge. Okay, so now let's get into the actual project. The actual project is located in Tyler-Longview, which is Tyler and Longview. Those are 2 cities in East Texas. It consists of 4 facilities, so 2 in Tyler and 2 in Longview. These projects are already at high occupancy, over 90%, which is pretty it's a pretty well-established occupancy from a risk perspective. And we'll purchase these 4 facilities for a total of $8 million. And couple other high-level things to note. There is plenty of operational upside. So the properties just haven't been operated very efficiently. They've had an out-of-state owner, and we can really juice the returns. And also there's room for expansion. So there's actually 3 parcels. One of those parcels is included in this current deal, is planned for expansion, an additional 20,000 units. And there are 2 other parcels which we're not exactly sure what will happen. Those particular parcels have not been included in the return projections, so that would be like gravy that comes later on. This is a confidentiality and other disclaimer slide. Please don't forward this information without permission. And okay, so now let's get into the operator. So in any deal, there's 3 main components you want to look at. You want to look at the operator, you want to look at the market, and you want to look at the deal. we've kind of given an overview of the overall asset class. Now let's take a look at the operator. So we've chosen to work with Spartan Investment Group, who is an excellent operator based out of Colorado. Spartan has already 4,000 units under management, 25 employees, and $100 million worth of projects underway. Spartan has 200 active investors, has raised $30 million in private equity, and has completed 9 projects. We really like Spartan because they are an incredibly professional company. They live and breathe self-storage, so they're incredibly knowledgeable in this particular asset class. And they're some of the most professional people that I've come across in terms of how much information they provide. They're extremely transparent. They provide all of the due diligence that we need to put these deals through a rigorous due diligence process. And their projects offer great returns with a lot of potential upside, which hasn't even been really discussed yet. So here's a summary of the offering. I'm going to move this out of the way. So this is a 506C offering. That means it's a lot of letters and numbers. That basically means that this deal is only open to accredited investors. How do you know if you're an accredited investor? If you earn $200,000 per year, or you and your spouse have a combined income of $300,000 per year, you would qualify as an accredited investor. And the other qualification, you don't have to have both, but the or if you and your spouse together or independently have a joint net worth of $1 million outside of your personal residence. So if you meet either one of those qualifications, then you're an accredited investor and you can subscribe to this offering. So we're currently targeting a $4 million raise, and there are a couple of different classes. The sort of standard investment is a $50,000 investment. That's this Class A share. And for investors who are investing $50,000, they will receive the same returns that they would receive if they invested directly with Spartan Investment Group. And those returns are a 17.9% average annual return over a 5-year period. And for 25K investors, they will get almost the same exact returns, but it'll be more like a 17% average annual return. And that is because we'll put it just a couple extra small fees, like a 1.5% acquisition fee and half asset management fee every year. And those fees are just, we put those fees in so that we can pay for our legal costs and basically keep the lights on while the deal is progressing. If you look at the Class C share, the 500 class share, you'll see that the target annual return for that share is 20.2%. And so the delta between that 22.2% and the 17.9%, that's what we at Luxe Capital capture for all of the work that we do in vetting sponsors, pooling investors, and putting our private placement together.
Hey Suja, can I ask a question?
Sure.
On the unit price, should one of those, the first one, should it be 25, or don't understand the graph?
We don't actually have a column for the 25K investor. If you want to look at the 25K investor, just refer to the bottom left where it says.
So what's the difference between Class A and Class B then?
So the Class B shares get a slight equity bump compared to the Class A investors. And those are investors that have invested directly with us or Spartan. So like basically it's a way to entice investors to invest again with us rather than going to another operator. So the intention is that, after this deal is done, and if you want to invest with us again, then we'll offer you slightly improved returns compared to our first time investors.
So it's a repeat customer enticement.
Yeah, precisely.
Okay. Thanks.
Sure. Okay. So that's just an overview of the overall returns of the deal. This is what those returns would look like on a annualized basis. So about $1,100 in year one. Could you mute that, please? Thank you. There's a timer going off. Sorry, thanks. Okay, so $1,100 in year one, about $4,000 in year two. This is for a typical 50K class share. About $6,000 cash flow in year three, so on and so forth. In year five, there will be about $5,000 of cash flow, and there'll be a liquidity event where the investors will receive their principal back as well as another huge chunk of money. And all of that equates to a 17.9% average annual return. So why else do we like this particular deal? We kind of went over this already, but it's going to be cash flowing from day one. There's a low REIT presence, so that the market is very appealing because we don't have like the larger players in Tyler and Longview. The properties are already occupied at 90%. There's an out-of-state owner, so there's a lot of room for improving operations and bumping those returns. We have opportunities to add square footage, and it's 4 properties. It's a pretty sizable portfolio, so we can benefit from the economies of scale that come with that. Okay, let's dive into our feasibility analysis. So let's take a look at the Texas market. Well, we're mid-2021, and there is currently a market contraction in Texas due to the coronavirus. So the reality is that the economy in Texas has definitely contracted. However, there is a recovery projected in 21. And if one were to look at Texas as compared to the rest of the United States, it's a huge economy. It's bigger than 39 different states. So Texas is probably going to be more resilient just because of the sheer size of the market. So it's one of the reasons why we like being in Texas. And while things are definitely in a contractionary period, Texas is poised to recover and bounce back faster than probably most areas in the country. So this slide basically just shows how Tyler compares to the Tyler MSA compared to Texas and compares to the United States. So in all 3 categories, population, employment, and real gross product, Tyler is exceeding the overall United States average. As far as population, Tyler is at a 1.1% growth as opposed to the US, which is 7.72. But really impressive is that employment in Tyler is at a 1.99% growth for this 5-year period, as compared to 1.84%. So basically, the employment in Texas, in Tyler, is growing faster than the employment in Texas, and that's pretty remarkable. Also, the economy in Tyler is growing faster than the economy in the state of Texas. So those are very positive growth metrics that give us confidence in these particular markets. There's a fair amount of diversification in East Texas. It's not just oil. There's also healthcare, manufacturing, distribution, and food processing. It's a well-diversified market, and it's also well located on an interstate corridor. This is probably one of the most important slides in the feasibility study. If you look at the yellow bar, it shows the average B market rent for self-storage here in Tyler and here in Longview. We're not trying to compete with the A market self-storage units. We're trying to compete with the B market self-storage units. And these blue columns these 2 blue columns on the left are our project's average rents. And when you look at the delta, this 55 compared to 88, there's a huge difference between where our properties are priced and what the market average is priced. Same with the attic, it's just a little bit under. Over here, we've got 73 to 92, almost $20, 69 to 92. So there's a really pretty significant delta that we can take advantage of just by bringing rents up to market rate. So when we look at like what a potential danger would be in buying these properties, really the biggest threat to any self-storage facility is new supply coming online. So we want to look at saturation and demand of any particular market. So what this basically shows is that in the at the intersection where Metro self-storage is, there's an extra demand of 49,728. That's equivalent to about one whole self-storage facility. So what that means is that there could be a whole nother self-storage facility built on the same intersection as Metro self-storage, and we would still be well positioned to be able to raise our rents to market rate. The only market where that's not the case is Highway 155. However, the oversupply is about 15,000, which is really only a quarter of a facility, which is typically about 60,000 square feet. So as a whole, this portfolio is very well positioned relative to the saturation and demand. So another thing that I just want to mention about bringing rents up to market rate is that with self-storage, when you raise a rent by $10, that actually ends up being about only $120 per year. And most people are not necessarily going to change unless they really can find a better deal that's significantly better than what they're already getting. And they're not going to want to spend a day of their life moving their stuff to save $120 typically, unless they really can find a much lower priced offer. And so that's why we look at this slide. It's like we want to make sure that we actually are under market. So if we provide a better product with at an equal or lower price, then we will not have an issue with people moving out. Okay, so now I'm just going to let's just actually look at the physical assets that we're purchasing. Here's Highway 155. With this property, you can see that one of the improvements we're going to make is these orange swing doors. Those will be improved to roll-up doors. But as you can see, very solid bones, great visibility, already great signage. We're going to improve the manager's office. We're going to spruce up the property. We're going to put in a high-tech security system. Here's the attic. Again, very strong bones. So it's already a great property, and we're just going to make it even better. Here's Gilmer. As you can see, all these properties are one story. They have these wide aisles, which make it really easy to access. They all have managers' offices, which we're going to renovate. We're going to improve signage in all the properties. And Metro, this is one of the properties where we have a planned renovation or expansion, actually. So there's a 20,000 square foot facility we're going to expand and actually build new self-storage on this very property. And as I mentioned, there's two other facilities between these properties. There's two other parcels that we can build out as well, either a self-storage or medical office or something of that nature. And okay, so what does improvement look like at a self-storage facility? So we'll, as I mentioned, replace swing doors with roll-ups. We'll repair the drive aisles as needed, repair all roofs, although the roofs are in pretty good shape. We'll make sure that they're all leak-free. Renovate offices, repaint and repair all building damage, place security cameras with a modern system, and enhance the signage. So that's the capital improvement plan. Now let's look at the operational improvement plan. Increase to market rate. So there's lots of ways to improve the operations at a self-storage facility and automate it. One of those ways is implementing a 24-hour online booking and call center. We also want to improve the customer experience, so we have extensive staff training to make the customer experience as smooth as possible. We will develop community partnerships to bring demand for the properties up. We'll target business relationships. We'll have a great digital marketing campaign, and we'll add ancillary revenue streams like tenant insurance. So what is asset management? So when you think of property management, that's managing the day-to-day activities at a facility. Did someone pay rent on time? Do I need to charge them a late fee, etc.? Asset management is managing at a higher level. It's managing the entire life cycle of the deal. It's managing the capital stack, so managing the lender, understanding if there's going to be a refinance, managing when the disposition will happen, taking on the liability, and keeping an eye on the market to see if it's time to sell or take another course of action. Okay, so now we're gonna look at the financial analysis of the property. This is the capital stack. So as we said, there'll be $4 million of equity raised. There will be a $7 million loan. Together, that's $11 million. And what is that paying for? So $8 million is for the purchase of the property as is. $1.15 million is for new construction of that 20,000 square foot building on Metro, which we talked about. There will be $800,000 for the initial capital improvements that we went over, like the roll-up doors, $190K for closing costs. $300,000 will be kept in reserves. We like to have a pretty robust reserve account in case something goes wrong with the property. The sponsor, so Spartan, will take upfront project management fees for all the work that they did in bringing this deal to market. And there's just a small amount of unallocated expenses. So there's a lot of numbers here. What's important, we're going to skip to the profit and loss statement, and we're just going to look at what's important. So the net ordinary income in year one is $94,000. I know that these numbers might be hard to see, so I'll say them out loud. By year 5, the net operating income will be $600,000. So that's increasing the net income by a factor of 6. And that increase is coming from adding those 20,000 square feet and bringing the properties up to market rent and improving operational efficiencies, not through market appreciation. So let's look at the DSCR ratio. So this is a really important metric to look at the risk profile of a deal. We start out at 1.51. So what that means is that in order to cover our debt payments, we have 50% more revenue than we need in order to cover our debt. So if our debt payment is $1 million a year, then we're bringing in $1.5 million in net revenue per year. That's a really, really great position to start in. Most lenders will require 1.25, and to be at 1.51 is a really favorable position to start in. That position just improves over the life of the deal. You might not be able to see these numbers very well, but it improves to 2.95% year 5. So again, like from a risk perspective, this is a very favorable offering. Now we're going to look at the value of the deal. So if we sell in year 5, we are projecting to create $3.8 million of value. And the cash on cash that's projected for the last 3 years is between 11 and 12%. Now it's higher in those years because we need to catch up for the earlier years where it's a little bit lower. This deal has a 7% preferred return. That means that investors are provided with a 7% return before the sponsor, which is Spartan, captures any extra cash flow. So because there is a slightly lower projected return, 2.4% in year 1, that's because we're building a new facility. So we're borrowing extra money so that we can build 20,000 square feet, and we have to pay debt service on that. And so we're not distributing as much in order to be well positioned to put out more cash as the years progress. But if you look at the overall average, that's a 9% average cash on cash return, which is pretty healthy returns for cash on cash. So this is just reviewing the liquidity events and the cash flow for all the different classes. This is the one to focus on for $50,000 investors. We've kind of been over this, but just to reiterate, about $1,100 in year 1, $4,000 in year 2, $6,250 year 3, $5,400 year 4, $5,000 in year 5, and then there'll be a liquidity event where there'll be an additional $22,600 upon sale. So this is how we like to bookend our deals and look at the likely scenario, but then also look at the worst case scenario that we're projecting and the best case scenario that we're projecting. Just a way to bookend these deals so that we can understand what the worst case scenario might be and the best case scenario. So as you can see in this annualized cash on cash return line, a likely scenario is about a 18 or 19% cash on cash return. Worst case scenario is about a 12% cash on cash return, and best case scenario is about a 25% cash on cash return. Okay, so we want to be upfront about the fees that are being charged. So the sponsor gets an acquisition fee for putting the deal together, and their acquisition fee that goes directly to Spartan is 3% of the project cost. They will also receive a 2% project management fee for developing that 20,000 square foot project at Metro. And as far as ongoing fees, they are the property manager. It's one of the reasons why we love Spartan is that they're a vertically integrated firm. They have their own property management firm, and they fine-tuned property management at these self-storage assets. So they receive a property management fee of 5%, and they also do asset management of this particular offering. So they have a 0.5% asset management fee on a yearly basis. If they act as the broker and sell the property, they will receive 2%. However, if they use a broker, then the broker will will charge 6%. So they'll actually save investors money if they end up disposing the deal themselves. And for those 2 gravy parcels, if they develop them, they will receive a 4% development management fee. That incentivizes them to develop those parcels and get investors their higher returns. So yes, in closing, I am Sujata Shah, Managing Principal of Luxe Capital. There's a little bit about me. And if you are interested in this offering, the next steps are to email me, and then I will send you any documents that you'd like to review. You will complete an accredited investor verification and also the offering docs. Then you will wire the money and receive corporate documents, and then your job is done. You basically sit back and receive returns.